Hey everybody, David Hedges here and welcome to Whiteboard Wednesday. I just wanted to go through a concept with you real quickly. I had a married couple in here, a man and woman. They were in their early 60s and as we talked about all of their assets and getting ready for retirement and so on and so forth, one of the things that they brought up was a concern to them was long-term care, and if they ever needed long-term care and the expense associated with it. And of course, long story short, after going through a number of options and looking at traditional long-term care insurance and so on and so forth, I discovered that on each of them, they had life insurance policies that had death benefits of about $100,000 a piece. So we've got two life insurance policies, right, on him and her. And again, the death benefit is $100,000. Cash value for each of these was $50,000. They were whole life policies. And I asked them what the intended purpose of the insurance was. And they answered, well, in case something happens to one of us prematurely. Well, of course. And so if something happens to one of them prematurely, one predeceases the other, that money, again, the direct beneficiary is going to be the other. But I go, is it really necessary at this point? And they looked at each other and said, not really. And based upon the level of their assets, it wasn't really, right? They had a very stout balance sheet and they were worth a decent amount of money. Their net worth was enough where, again, a death benefit of $100,000 wasn't really going to move the needle much as far as, you know, what they needed, just because they had plenty. And so I'm like, okay, so let me throw something out there at you. And it's a concept that's a little bit different and people aren't necessarily aware of this, which is a life insurance policy that can also act somewhat as a long-term care insurance policy. So these policies that they had did not have any type of a rider that was included or that they were paying additional money for that could operate like kind of a pseudo long-term care policy, but there are contracts out there that do. And let me explain real quickly how they work. So let's say you had the $50,000 cash value and you moved it to a policy that actually had this long-term care kind of rider, right? They're not allowed to call it a long-term care rider necessarily. It's more like a continuing care rider benefit is what some of the insurance companies call it. But it operates much like a long-term care policy in the fact that the benefit trigger, you have to have 2 out of the 6 ADLs, right, that you cannot do, right, certified by your physician. And then that's the benefit trigger. But long story short, moving this $50,000 into another policy, they were able to achieve a $250,000 death benefit each, okay? And with the rider that was included in this particular insurance policy, this $250,000 now can be used as like continuing care. Again, they're not allowed to call it a long-term care insurance policy, but the benefit pays much the same, with the 2 out of 6 ADLs being the benefit trigger if you can't do 2 out of 6 ADLs. And the insurance company will advance this, dependent upon the insurance company, they will advance this up to like 4% per year of the policy. So you've got a decent amount of funds that you can actually, 4% per month of the policy that you can actually use for long-term care. And again, depending upon the contract, you can use it at home or in assisted living or so on and so forth. But again, a viable alternative to going out there and shopping for very expensive long-term care insurance, as we know it is, and also just sitting here with insurance policies that really weren't necessary because of the level of their assets that they had and that didn't really serve the purpose that it was intended to serve way back when they bought them 30 years ago. Again, they don't necessarily need the $100,000 of death benefit. So again, just a quick concept on how to reposition money on a balance sheet to better serve a purpose that is a more current purpose, whereas the outdated purpose of that death benefit is, again, not necessarily viable because they don't really need the extra liquidity at this point. They have enough assets that they have accumulated over time. So again, just a quick concept that may be helpful in the future. Thanks, I hope you have a great day. Bye-bye.